Let's continue this conversation. Just how bifurcated is this credit market? Because on the surface, it looks like we've had a big rally off the lows at the middle of March. Are we drawing a distinction between the weaker credits and the stronger ones?
Great speaking to you, Jonathan. I would say there's a very, very significant bifurcation. The distressed area that you just talked about is going to be highly dependent about the timing of the recovery here, timing of reopening, and how confident consumers are going to be in terms of spending. I think the distressed sector is going to be very similar to the equity market, highly reliant upon those factors. You look more broadly at the credit markets, though, you don't really need to thrive in this environment as a credit to survive. And when you think about being a credit investor more broadly in the investment grade market, in the high yield market, you're really talking about survival. Can you pay your debt? And I think you're not as reliant upon getting back to 3.5% growth, getting back to 3% unemployment. Obviously, the impact on the broader economy is going to have an impact on the companies you just talked about, but there are other factors that are driving the credit markets right now, which are much more significant than the calculus in terms of how big the recovery is going to be and when it's going to be.
Well, let's talk about those factors, Mike. What are the primary drivers for you?
So the number one factor is central bank policy. Policy is easy, and the Fed is buying corporate credit for the first time. Very, very significant support for the market, which gives companies the ability to be able to access markets and to be able to term out their debt. And that is the most critical factor to a company's ability to be able to survive. And secondly, it's creating an enormous amount of demand for income in the credit markets. People are comfortable that there's a backstop from the Fed. And if you look on a global basis, yields are 0 to negative almost everywhere. The U.S. market, even though short-term rates are at 0, is the high-yield market, the high-yielding market in the globe, and the reason for it is because of the credit market. And so when you look at negative rates in Europe, you look at negative rates in Japan, you now look at 0% Treasury rates, people have to go somewhere, and they're going to the U.S. credit markets as that safe haven. And the Fed now is looking at credit as a very, very important policy tool. So in the past, we looked at Treasuries as the factor that would go down in rates if there's a slowdown in the economy. Now we feel that the Fed is looking at the credit market as a very important policy tool. So I think that that global demand for credit as well, or yield, as well as the support from the Fed is a very, very supportive backdrop for credit, and one that you really as an investor do not want to fade.